right. Good afternoon, everybody. If you could take your seats, please. We are a little ahead of schedule. So, good morning, everyone, and welcome to this press conference with Commissioner Dombrovskis. Of course, our topic today is the autumn economic forecast. Before we jump in, let me remind you that we have a technical briefing after this event where questions of technical nature can be raised. So the Commissioner will start with some opening remarks, and then afterwards we'll take a few questions from you. Commissioner, please.
So, good morning, everyone. Let me begin by setting out four key messages from our autumn 2025 economic forecast. First, on growth. The EU's economy has beaten expectations in the first 9 months of the year. Looking further ahead, we expect growth to continue at a moderate pace despite the challenging external environment. Second, on inflation. Inflation is on track to be around 2% target in the euro area and only slightly higher in the EU over the forecast horizon. A sustained return to stable prices is good news for European consumers who had seen their purchasing power eroded by inflation in recent years. Third, on public finances. The overall fiscal situation has improved significantly since the COVID-19 pandemic. However, we expect less positive developments in the coming years with debt and deficit ratios edging up. This is especially the case in certain member states. We must remain vigilant to safeguard the fiscal sustainability. It provides a foundation to build a strong and sustainable European economy. First, and perhaps maybe most significantly, on uncertainty. This forecast is clouded by significant uncertainty, and this will remain a defining feature in coming years. The challenging external environment means that we should look at domestic drivers to fuel growth. Europe must rely on and develop its own strengths. This means redoubling our efforts to enhance our competitiveness and unlocking Europe's full growth potential. The message is clear: we must act, and we must act now. Let me begin by taking a closer look at how developments in global trade have created a more challenging external environment. Globally, trade barriers have reached historic highs. We anticipate that trade policy decisions by the US and the responses by other key players like China will dampen global trade. This forecast assumes that all tariffs implemented or credibly announced by the US by the cutoff date will remain in place throughout the forecast horizon. The average tariff rate faced by EU exporters to the US stands around 10%. This is slightly higher than in spring and significantly above the average tariffs before the Trump administration took office. Of course, the EU's highly open economy remains susceptible to ongoing trade restrictions and uncertainty. At the same time, the EU faces lower average tariffs relative to many other economies, including China or India. This provides the EU economy with a relative advantage, albeit in a context of weak global goods trade and strong euro tempering foreign demand. Now, turning to the global growth picture. Global economic activity expanded more vigorously than expected during the first half of 2025. The US and Japan, but also China, recorded stronger growth than previously projected. This is largely due to the trade front-loading and improved financial conditions. Recent survey data point to further economic expansion in the third quarter, with activity in services continue to outpace manufacturing. However, global growth is forecast to decelerate in the second half of this year. It will then stabilize, being dragged down by high tariffs and elevated policy uncertainty. Global growth, excluding the EU, is set to slow down from 3.7% last year to 3.4% in 2025 and 26, before edging back up to 3.5% in 2027. Real GDP forecast in the US is expected to fall to 1.8% in 2025 from 2.8% last year. As you can see from the graph behind me, the EU's contribution to global growth remains modest. This reflects a growth gap between the EU and other better performing competitors. It demonstrates the EU needs to step up action to reverse the trend of falling behind and catch up with other regions in terms of productivity and growth. Turning now to examine growth and what's driving it. We forecast the EU economy to grow by 1.4% in both 2025 and 26 before edging up to 1.5% in 2027. Better than expected growth so far this year stems from a surge of exports ahead of anticipated tariff increase. But continued growth in the third quarter demonstrates the EU's economy's overall resilience in navigating a highly challenging and uncertain environment. Improved economic sentiment in October points to continued positive growth momentum. Key conditions for an expansion in economic activity continue to remain in place. Growth will rely on domestic demand. Private consumption is projected to grow at a steady 1.5%. This is supported by a resilient labor market, improving purchasing power, and a mild decline in a savings rate. Gross fixed capital formation, or investments in assets in simpler terms, will likely outperform expectations from the spring forecast. So we have also revised up the outlook for 2026. This takes into account the impact of German fiscal stimulus and the greater deployment of funds from the Recovery and Resilience Facility. Still, as I already mentioned, the EU's highly open economy remains vulnerable to increased trade restrictions. Growth in goods exports is expected to slow down next year before rebounding mildly in 2027. This will be partly supported by the EU's relative tariff advantage in the US market compared with other major trading partners. Meanwhile, export of services are projected to continue growing robustly throughout the forecast period. Overall, the contribution of net exports to growth is expected to be negative this year and next before becoming neutral in 2027. So I repeat my earlier point, Europe must rely on Europe for growth. The good news is that the economies of all EU member states are set to expand this year. While we must strive for a greater level of growth, we should also acknowledge that this is not an insignificant achievement considering the very challenging environment. In 2026 and 27, we see growth picking up or remaining robust in most member states. Turning now to one of the EU's economy's strongest assets. Our labor market remains impressively resilient. The EU economy generated an additional 380,000 jobs in the first half of 2025. While employment growth slowed down, economic activity accelerated. This has resulted in significant and encouraging productivity gains this year. Employment in the EU is set to continue expanding moderately by 0.5% this year and next, before decelerating to 0.4% in 2027. The EU unemployment rate is anticipated to edge down further from 5.9% in 2025 and also 26 to 5.8% in 2027. Wage growth continued to decelerate in the first half of 2025. It is expected to decelerate further while remaining positive. In the EU, nominal wage growth is expected to decline from 5.1% in 2024 to 4.0% this year, 3.3% in 2026, and 3.1% in 2027. Importantly, thanks to inflation stabilizing around 2%, real wage growth will allow people's purchasing power to continue increasing. Those members with the highest wage growth in 2025 are also projected to record the steepest decelerations in the next 2 years. Differences in compensation per employee across member states are expected to narrow progressively over the forecast horizon. Thanks to productivity gains and wage moderation, growth in unit labor costs is set to slow down significantly in 2026 to 27. Inflation is projected to stabilize. It is expected to fall to 2.1% this year and hover around 2% in 2026 and 27 in the euro area. In the EU, inflation is set to remain marginally higher, falling to 2.2% in 2027. Moderation in headline inflation, both in the EU and the euro area, is largely thanks to falling inflation in services and food. Intensifying competitive pressures from imports and appreciation of euro should restrain inflation in non-energy goods. This is especially welcome for households that have seen rising costs erode their purchasing power in recent years. While inflation keeps falling in most member states, intra-EU inflation differences have increased recently. As you can see from the map behind me, inflation is set to remain higher in Central and Eastern European countries. This is due to stronger growth in unit labor costs, but also higher expected energy inflation. However, these intra-EU differences are expected to become smaller in 2026 and 27. Now, turning to public finances. After declining to 3.1% of GDP in 2024, the EU general government deficit is projected to edge up to 3.3% of GDP this year and 3.4% 2026 and 27. This largely reflects a shift in political priorities and necessities. Defense spending is projected to rise steadily from 1.5% of GDP in 2024 to 2% in 2027. This is according to the COFOG methodology. It is worth noting that the forecast considers only the defense spending that was sufficiently detailed and credibly announced by the cut-off date of forecast, which was 31st of October. This means, for example, that the national investment plans currently being prepared by member states, which includes the use of financial assistance by a SAFE program, could not be included in the forecast. We therefore expect the figure for defense spending to increase further once these plans are taken into account. Interest expenditure is also set to grow further. However, fiscal adjustments in most member states are expected to partially offset these deficit-increasing factors. EU government debt is projected to rise from 82% of GDP in 2024 to 85% of GDP in 2027. This increase is driven by two factors: persistent primary deficits and the fact that the average cost of public debt is higher than nominal GDP growth. Sound public finances are the foundation of macroeconomic stability and sustainable growth. Looking ahead, Member States will need to pursue prudent policies to safeguard the sustainability of public finances. This involves reprioritizing national budgets and taking measures to enhance the effectiveness, efficiency, quality and composition of public revenues and expenditure. Looking at the fiscal position of Member States in closer detail, we see that 11 Member States are expected to have deficits exceeding 3% of GDP this year. These are Belgium, Germany, France, Latvia, Malta, Austria, Slovakia, Finland, Hungary, Poland and Romania. In Italy, the deficit is projected to drop below 3% of GDP this year and decrease further in following years. I will conclude with reference to significant uncertainty that surrounds this forecast. The road ahead contains both downside risks and opportunities. So let's start with risks. Uncertainty around trade policy remains high. The impact of the current tariffs and non-tariff restrictions on the European economy might be greater than expected. An escalation of geopolitical tensions could exacerbate negative supply shocks and undermine confidence. Reprising of risks in equity markets, especially in the US technology sector, could impact investor confidence and financing conditions. Domestically, political uncertainty might affect confidence. In light of these factors, the EU must take resolute action to unlock growth. There are also opportunities to seize. The pressures arising from the changing and challenging world could serve as a catalyst for reforms here at home. At the EU level, we have a clear roadmap to guide such reforms in our competitiveness compass. Continuing to implement the measures set out in the compass, such as simplification, completing the single market and boosting innovation, could bolster economic activity more than projected. Elsewhere, higher defence spending focused on EU production and continued success in diversifying our trade could also contribute to growth. Of course, these efforts must be complemented by growth-enhancing reforms in Member States. Overall, we can no longer afford to contend with just getting by. We have a window of opportunity and we must seize it now. Thank you.
Thank you very much, Commissioner. Let's take a few questions. Thomas, we start with you.
Hello, Thomas Mann-Nilsson at Euractiv. Thank you very much for the briefing. I have two questions. So one about the increased growth forecast for this year. So I've noticed Germany and Spain have had their growth forecasts significantly increased. I mean, how big a factor were they in this upward revision for the EU and the eurozone this year? And also regarding the deficits in France and Romania. So I saw Romania's deficit. Its forecast deficit for this year has been increased, but significantly for this year, but decreased significantly for 2026. Also, France's deficit forecast for 2026 has been decreased significantly. Could you comment on these? I mean, are you happy with the direction that these deficits are going in, or do you think more fiscal consolidation is needed? Thank you very much.
Yes. As regards the revision of the forecast to compare with the spring forecast, as I said, we have updated upwards our growth forecast for both EU as a whole and euro area. And of course, Germany, as EU's biggest economy, plays a role there in this upgrade. And I already was mentioning the impact of German fiscal stimulus package on the also overall EU growth outlook. So that certainly is a positive spillover for the entire EU, and similarly also quite robust growth rates which we are seeing in Spain. Then on fiscal, indeed, as regards Romania is having by far the highest budget deficit in the EU, so it's important that government is taking substantial fiscal consolidation measures to bring the deficit down to a more sustainable level. So indeed we forecast therefore it to go down from 9.3% last year to 8.4% next year, and slightly above 6% in 6.2% in 2026. We, in case of Romania, we acknowledge the fiscal effort which has been done by the government so far. This also allowed Romania to maintain investment-grade credit ratings, but obviously it's important that Romania continues this adjustment and eventually brings the budget deficit below 3% of GDP as set out in the fiscal past in the excessive deficit procedure. On France, also in the case of France, there is certain fiscal adjustment measures being taken, which would allow budget deficit to go down from a projected 5.5% this year to 4.9% next year. In case of France, of course, we have to note that the next year's budget is still being debated in Parliament, so we must see also the outcome of those discussions and whether all the measures foreseen by the government as it was submitting its draft budget to the Parliament will be maintained through the parliamentary debate, and there are also some other elements. For example, we are forecasting slightly higher interest expenditure in France, which puts our budget deficit forecast slightly higher than what has been submitted by France in their draft budget.
Thank you. Jorge, please.
Good morning. Jorge Valero with Bloomberg. Two questions. First on the uncertainty issue and also your revision upwards of the growth forecast. To what extent the trade tensions, not only with the US but also with China, were taken into account? And if the risk of disruptions on the European industry given to the minerals restrictions were contemplated, and to what extent you consider this as a significant impact or not? Whether you see that this could have an impact on the growth forecast, not only for this year but especially for next year. And secondly, given the delicate situation of the public finances across the board in Europe, to what extent you are concerned about the risk of a bubble burst in the US stock market, and these factors, this burst spread into other economic sectors and crossing the Atlantic?
Yes. So on the first question on the impact of tariffs and trade uncertainty, I was already mentioning it is one of the factors which negatively affects economic growth in the EU. So we had updated our quantitative assessment on impact of US tariffs on the EU economy, which is expected to range somewhere between 0.1 and 0.3%. But obviously there are further risks in terms of global trade fragmentation, in terms of also, in a sense, certain reshuffling of the trade flows. For example, the goods which are not going through China to the US due to high tariffs, seeking other markets, including the EU market. So, but in this we still have high uncertainty and something we need to monitor closely and be able to react as situation evolves. We managed to mitigate some of the negative factors. For example, China has suspended its additional export control measures on rare earths, which it announced last month. This is certainly a positive factor in the short term, but also reminds us about the need to diversify our trade flows and also diversify our value chains as regards rare earths and critical minerals, because many of those value chains are dominated by China. Therefore, we have announced this resource EU strategy to address how we are actually going to diversify those supplies. On the questions on risks of or risk reassessment concerning the equity markets in US, notably in a technology and AI sector. Again, this is one of the risks I mentioned to our economic, through our economic forecast. We probably not are directly so much exposed to this, but certainly it can affect investor confidence and it can affect financing conditions. So there may be indirect effects also on the EU economy.
Super, thank you. Question in the front, Susana, please.
Thank you, Susana Freixas with SIC and Expresso Portugal. We see that you no longer see a surplus in Portugal this year, and you point to a 0.3 deficit next year. So I would like to understand, first of all, if this is a matter of concern when we see that the EU deficit average is over 3%. And if I may, the European Commission has been asking Portugal and the Portuguese government to phase out fossil fuel subsidies. I would like to understand if it's true that you wrote to the government to accelerate that phasing out, and if you are proposing a specific date for these subsidies to be over. Thank you.
Yes. So as regards situation in Portugal, indeed we expect a balanced budget in Portugal this year and a deficit of 0.3% of GDP next year. Indeed, that deviates somewhat from government forecast, which forecast a surplus of 0.3% this year and 0.1% next year. Well, the main drivers of difference relate to Commission's slightly more prudent estimates of expenditure growth and notably current expenditure. And it's worth noting that the European Commission's forecast for next year is still more optimistic than a forecast of Fiscal Council, which puts the deficit next year at 0.6% of GDP, and also the forecast of Bank of Portugal, which puts at 1.3% of GDP. As regards the energy support measures. So indeed, one of the measures in October 2021, the government reduced excise duty on energy products in response to increase in energy prices. By the cut-off date of Commission forecast, the government did not announce a phase-out of this measure. Therefore, this measure is forecast to remain in place in the figures I was just talking about. But it's true that we are calling on government to phase out those energy support measures, which had been put in place following the energy price increases following Russia's aggression against Ukraine. On specific letters, I will probably ask colleagues to follow up.
David Carretta, please.
Thank you. David Carretta, Radio Radicale, Italian Radio. I'm here. Good morning, Commissioner. Two questions on Italy, if I may. The first one on growth, because we are seeing growth coming back to what has been the history of Italy, so lagging behind the others, even if Italy is one of the main beneficiaries of RRF grants and loans. I'm wondering if you can comment on that. I mean, today, I guess the contribution of RRF investment for 2025 are the main reason why Italy is still growing. Is it correct? The second question is on deficit. You said in your speech that the deficit for 2025 will drop below 3% in the case of Italy. What does it mean? Would you be able to recommend already in the autumn package to end the excessive deficit procedure, also because this is important for the government to activate the national escape clause on defence, which is a EU priority, or you will have to legally wait for the Eurostat notification in the spring. Thank you.
Yes. As regards economic growth in Italy, indeed we expect modest growth at 0.4% this year and 0.8% next 2 years. And similarly, like in many countries, we see this being driven by household consumption and also in investments. On investments, indeed, right now, Recovery and Resilience Facility is a major driver of public investment, but it has to be said, following the end of Recovery and Resilience Facility next year, we will be in a stage of multi-annual financial framework where we can expect a pick-up of cohesion funding and cohesion investment, which also will help to sustain the level of public investment. Then, on the question of budget deficit, well, we had discussed it several times with Italian authorities. So for the Commission to abrogate Italy from excessive deficit procedure, we need to see the outturn data of 2025 as verified by Eurostat. This data will be available in April. Correspondingly, possible abrogation, if deficit is confirmed below 3% of GDP, could take place in next spring European semester package.
Thank you. Let's go to the right. Carl.
Good morning, Commissioner. Carl for the French daily Les Echos. I have a French question now. I see that you forecast a deficit of 4.9% next year for France and 5.3% in 27. And according to your tables, the total debt for France could reach 120% of GDP in 27. Can you please tell us how concerned you are by these figures? What do you hear by the new French government? And do you think that these figures could lead to more downgrades by the international ratings agencies? Thank you.
Mm-hmm. Yes. First of all, on France's fiscal developments, we acknowledge the fiscal adjustment measures taken by government, which will allow the budget deficit going down next year. But at the same time, we see that there are some developments, for example, suspension of pensions reform, unless there are offsetting measures put in place. The fiscal cost of this is going to accelerate quite substantially over the years, with, so to say, relatively small impact this year, but growing with each consecutive year. So therefore, it's important to see what kind of offsetting measures are being put in place. On specific differences between the draft budget for 2026 and the Commission's forecast, I already elaborated it a bit. And in a case with still elevated budget deficit and growing public debt, obviously it's important to continue this work to ensure sustainability on fiscal finances and also sticking with the trajectory set out in a medium-term fiscal structural plan.
Thank you very much. Maria, please.
Thank you. Maria Psara with FC Newspaper Greece. On Greece, the news is very good as far as we have the RRF, but I would like to ask you if you are concerned about possible budgetary corrections, especially regarding the common agricultural policy, because we have this scandal of OPEC that will need many corrections. Are you concerned about this, that maybe the budgetary corrections will drive crazy the budget of Greece? Thank you.
Yeah, well, overall, Greece is maintaining strong growth momentum, so we expect 2.1% growth this year, 2.2% next year, so well above EU and Euro area averages. Budget remains in surplus, debt to GDP ratio is going down, so all in all we see quite a strong performance of the Greek economy. As regards those specific issues related to common agricultural policy, there are ongoing audits currently going on. I cannot prejudge the outcome of those audits, and relevant Commission services are in contact with Greek authorities.
Super. Sabina, you had a question?
Yes, thank you, Sabina Rosetta. Just a clarification. Do you expect the deficit on GDP for Italy to be below 3% in 2025 or at 3%? Because it wasn't clear. Thank you.
Yes. So the Commission forecast puts it at 3.0% of GDP. In contacts with Italian authorities have several times confirmed their intention to actually make sure that it's slightly below 3% of GDP, exactly with a view of abrogating excessive deficit procedure.
Okay, thank you very much. In the front. Yes. Yes, you.
Andres Estun from Expansión. I would like to know if you could explain us how the delay of the ETS2 has affected your inflation forecast. Thank you.
Well, in this case, well, by the cut-off date, these decisions were still up in the air. So our forecast is expecting ETS to come into force, ETS2 to come into force as of 2027. So the expected aggregate effect on the inflation from this measure is expected to be 0.35%. Should the ETS2 be postponed to 2028, as it now seems to be the case, that correspondingly would lead to this adjustment moving from 27 to 28 in terms of inflation.
Thank you. If I may take two more questions, please. Yes, you.
Daniel from Neue Zürcher Zeitung, Switzerland. A question: you said that the average tariff rates a European company has to pay in the USA is rising over the months. So why is that? Because some producers have to pay 50% on steel and aluminum components. And if this is the case, what are you doing against this? Because I think it's somehow against the spirit of the joint statement with USA.
As regards those tariffs, basically we were comparing three sets of tariffs. Tariffs as they were pre-Trump or pre-Trump 2. Tariffs as they were announced in this quote-unquote Independence Day and then, or Liberation Day, how it was properly called, and then subsequently reduced to those interim tariffs of 10%, and tariffs as set out in EU-US joint statement. And that's where we arrived at this figure of tariffs U.S. businesses currently facing being on average around 10%. And that's where we arrive also on this conclusion of actually EU having relative advantage in terms of tariffs, because we note that many other major economies, including China, including India, and so on, are paying higher tariffs than the EU.
Okay, one last question. You go ahead. In the gray, yes, please.
Carlo Martuscelli from Politico. Thank you for taking my question. I wanted to know if your forecasts factored in at all EU-level reforms and whether these are expected to have any material impact between now and 2027. Thank you.
What the forecast is factoring in is measures decided or credibly announced by the time of the cut-off date of the forecast. And then the impact of those reforms is taken into account, both in terms of its impact on the growth trajectories in the member states implementing those reforms, and also on possible fiscal costs or reduction of fiscal costs regarding those reforms. But obviously that's one of the key messages coming also out of this forecast, that we cannot rely on external environment, external economic environment for EU growth, so we must unlock EU's own growth potential, including through growth-enhancing structural reforms.
Okay, I will have to cut it there. Thank you very much for showing an interest in this topic and for raising so many questions. I thank also the Commissioner for providing the answers. We will continue with a technical briefing in a few minutes. Thank you.